Insurance, whether life insurance or property insurance, is designed to help you deal with risks in life. It is a risk mitigation strategy that aims at transferring risk from you as an individual onto an insurance company. But it only works if the amount and type of insurance that you carry is calibrated to the risks that you face. And as you go through life and have experiences, the types of risks that you face are going to change, the liabilities that you incur are going to change, and unless you make adjustments to your insurance portfolio, you might find that your coverages simply don't work in your situation. In this video, I want to outline 10 common life changes, milestones that might affect the amount and type of insurance that you carry, or at least might prompt a reevaluation of your coverage. Now, I'm simply listing these 10 in order to get the wheels turning in your mind, to get you thinking about the kinds of scenarios that might impact your situation. Every person is going to be a little bit different. Some of these scenarios are not going to apply to you. In other cases, you might be able to think of a number of other scenarios that do apply to you that I don't cover. So the list is not exhaustive. There are many different lines of insurance. There's disability insurance, life insurance, long-term care insurance, property insurance, and so on. And as I move along, I might suggest different lines that could be affected by each of the categories that I'm mentioning. Number one is going to be a change in your relationship status. Maybe the most common example of this is going to be marriage, but it need not be a legal marriage. It could be any kind of domestic or business partnership that you enter into. A key feature that you're looking for is going to be financial dependence. Either you are going to be dependent on somebody else's income, they're going to be dependent on you, or there's some kind of a mutual interdependence between the two of you. But in this case, you're going to want to think through the impact that disability or death is going to have on the total financial picture. So entering into a relationship where there is financial interdependence or dependence is certainly a reason to reevaluate coverages like disability insurance. Would you have a guaranteed paycheck in the event that somebody were incapacitated, whether through physical injury or some kind of a health condition or disease like cancer? And another major one is going to be death. What would the other dependent party do if the breadwinner were to pass away? Now, in other videos, I get into more of these uses, so I don't want to dwell on them, but suffice it to say that entering into a relationship might be cause to reevaluate your insurance portfolio. Now, I'm also going to mention long-term care. I'm really not going to dwell on it in this video because it's a complex discussion in and of itself, but suffice it to say that long-term care insurance is going to try and cover the risks that a person might face with respect to the end-of-life scenarios regarding nursing home care. Now, insurance needs are going to change as you enter into relationships, but they also might change when you exit relationships. So if you're ending a relationship with somebody, or if you have ended a relationship, that might also prompt a change in your insurance portfolio. For example, you may no longer wish to carry coverages that you had previously. You need to consult with competent financial professionals who are familiar with your situation. I can't provide specific advice, and in the case of ending coverages, you're going to want to make sure that any separation agreement or any divorce judgment that might be applicable doesn't have any relevant thing to say about maintaining insurance on the other party. Number two is going to be a change in your living arrangement. The preeminent thing here might be the purchase of a new house, but once again, it need not be something that large or dramatic. It could be remodeling a house or renovating it. Anytime you pour a substantial amount of money into a house, you're going to change its fair market value. You're also going to want to change, or at least look at, the various parameters of things like your homeowner's insurance policy to make sure that in the event of a catastrophic loss, you would actually receive a payout that was sufficient to, let's say, replace the brand new kitchen cabinets you just put in or the brand new appliances that you just spent money on. So in this case, some of the relevant lines of coverage are going to be homeowner's insurance, renter's insurance, but life insurance is also relevant in the sense that some people will calibrate a term policy payoff to the amount of mortgage debt that they have. So any change in the mortgage or any change in your overall debt picture might change the amount of coverage that you want to carry. So maybe you had to take out a loan in order to perform your remodeling, then you're going to want to factor that into your insurance portfolio as well. Number three is going to be the addition to your family through a birth of a child. Regardless of your view about children's insurance policies, having the child insured, the reality is kids cost money. Insofar as you have a mutual financial relationship with somebody else, having a child enter that picture is going to put a significant liability on top of whatever other liabilities you already are dealing with. So in usual terms, a child won't be emancipated for roughly 18 years. So having a child is going to bring an 18-year financial commitment into any relationship, and that's going to need to be factored in as well. Once again, policy lines that might be most relevant here are going to be things like the disability insurance and the life insurance. Number four, the child is going to experience milestones, and those milestones might prompt you to reevaluate your own life insurance. In some cases, some of these milestones might add to your liability and risk, and in some cases they might reduce it. So for example, if the child starts driving and you have to add the child onto your car insurance, that's likely to increase your premium cost. Additionally, if the child goes to college and you have co-signed for unforgivable loans, that also is going to tend to put an upward pressure on the amount of risk that you have. On the other hand, if the child has moved out, is now on his or her own, and you have no more financial obligations to the child, that's going to tend to reduce the amount of insurance liability that you have. So some relevant lines there: disability again, life insurance, but also property and casualty policies. Number 5 is going to be job related, and this one I have in mind: getting a new job. Getting a new job, you're either going to have the same level of income, you're going to have a greater amount, or a lesser amount. But regardless of what happens with your income, you're likely to have a different benefit structure. You're likely to have different 401k plan than you did before. Maybe you now have a 403b instead of a 401k. So there's going to be a lot of relevant changes that are going to impact your living situation, your income and expenses, and also your retirement plan. There is such a thing as a life insurance retirement plan, and that acts as a supplement to the other kinds of retirement preparations that you're making. Now's not the time to get into it, but suffice it to say that a new job might prompt that conversation. Just a more run-of-the-mill example would be if your income has gone up or down, then the amount of term coverage that you carry, insofar as your term coverage is designed to replace a multiple of your income, would need to change. So you might have to change the amount of term coverage that you carry if your income changes. An unhappier eventuality that would be job related would be a layoff or a termination. Unfortunately, a lot of people are going through those these days. So the first thing is, when a person is laid off or terminated, the temptation might be to just start slashing coverages, cutting policy premiums in order to save money. And it's certainly understandable. Obviously, carrying a large life insurance policy that was calibrated to a previous salary may no longer be applicable if you have been terminated. On the other hand, you might want to also consider the amount of effort and money that would be required to try and get those policies going again in the event that you did discontinue them now. So if you've had a policy in place for 20 years, maybe your health condition has changed, certainly you're going to be older, you would be faced with the prospect of having to pay higher premiums if you tried to get those policies restarted. It doesn't make the decision easier. It's simply another factor that you might want to consider if you're faced with a job loss. Now, number 7, I kind of mentioned previously, and that is a change in your health condition. So this might be being diagnosed with some sort of an illness. It might be increasing or decreasing weight. Certainly, age increase is going to affect many lines of coverage, for example, life insurance, and all of those factors can be relevant when you're assessing or reassessing your insurance portfolio. Some conditions may affect your life insurance insurability. So, for example, a heart condition or diabetes, when they surface, those are going to have a negative effect on your insurability from the standpoint of life insurance. Other conditions may not have that same kind of an effect. So conditions like osteoarthritis might not affect your insurability from a life insurance standpoint, but they might affect your insurability for things like long-term care. A diagnosis of Alzheimer's disease will kill your insurability for life insurance and long-term care at the same time. Now, it sometimes happens that the diagnosis isn't for you, but it might be for a loved one, and this might affect your insurance portfolio, number 1, if they are dependent on you or if you're dependent on them. And number 2, just as an example. So I know that the experience that my dad and mom had with my dad being diagnosed with Alzheimer's disease put into my mind a kind of a fear of having Alzheimer's disease myself in the future. And so as a way of hedging against that particular eventuality, I looked into long-term care insurance well before a time period where you'd expect a lot of people to be looking into it. This also brings up an allied consideration, and that is sometimes people become caretakers for older adults as they start to age. That might also affect different aspects of your insurance portfolio. So number 9 is actually the death of a loved one. So the loved one's death might directly impact your finances in the case of a person who, let's say, was part of your household, depended on your income. It also might affect you indirectly. Let's say more of an example. So a person dying might prompt you to think about death, and that might prompt you to reevaluate your insurance portfolio yourself. But on the other hand, as was the case with my dad, his care cost a lot of money. It cost room and board in a nursing home. He had medications. And so upon his death, obviously those charges simply terminated. Either way, the death of a loved one could prompt the reevaluation of your insurance portfolio. And number 10, something that is sometimes tied with the death of a loved one, but need not be, is the reception or the giving of an inheritance. In some cases, when a person passes away, you might actually be the beneficiary of something from that person's estate. Could be money, It could be some valuable item. On the other hand, you might be interested in trying to create an estate or create a legacy for somebody else and leave an inheritance. In either case, you might want to start re-examining your insurance portfolio. Life insurance can certainly be relevant when you're trying to create a legacy. Also, property and casualty might be relevant. So for example, if you're the inheritor of some kind of a valuable collection of antiques, for instance, that's not going to be covered by your normal property and casualty policy. You're going to need to add various endorsements or other specialty items onto your policy in order to have the expectation that they would be covered. In order to really evaluate your situation, though, you're going to need to sit down with some sort of a professional. It could be a financial advisor, an insurance agent, it could be some kind of a CPA, depending on the circumstances. You might want to sit down with all of these people that I just named. My aim in this video was not to indicate whether any particular change was likely to increase your insurance needs or decrease them. It was rather simply to get the wheels turning about situations in your life that might prompt you to reevaluate your insurance needs on your own. This video has been for general, informational, or entertainment purposes only. If you need actual advice concerning your situation, you need to consult with licensed professionals in your area, people who are familiar with the ins and outs of your situation and can give you proper advice. But if you found something of use, I do ask you like the video, subscribe to the channel, click the notification bell to be alerted to new content as it becomes available. I thank you so much for being with me today, and I look forward to seeing you again in another video. Thank you so much.